Hello again, everyone. So in this lecture, we are going to combine demand and supply together, and we are going to come up with market equilibrium and all concepts which are associated with this. So the study plan for this particular lecture will be market mechanism, how exactly market equilibrium is established in a market due to movement in prices, deficit or shortage and surplus of goods on the market. So what happens to quantity demanded and supplied when price is different from the equilibrium price? How will the market respond to these situations? How changes in market equilibrium will take place due to various shifts in demand and supply curves. So basically, we'll start applying our demand and supply model, we will start shifting the curves, and we will see how exactly this will affect the location of equilibrium point and how this will change the equilibrium price and quantity. There will be at least 3 difficult questions in your exam based on the material covered in this lecture. That is why please make sure that you cover every single bit in this particular lecture, and also you will need to practice your seminars. I will tell you exactly what sort of questions to expect in your exam, but please make sure that you practice for them. So let's move on. First concept which we need to cover is market equilibrium. Market equilibrium is simply a point where demand curve crosses supply. So this will be a point where these 2 points cross, and this will determine equilibrium price, which we normally label as P star in economics, and equilibrium quantity, Q star. The actual equation which describes market equilibrium condition is written down here. Market equilibrium is a point where quantity demanded is equal to quantity supplied. This will take place at one particular price, which is called equilibrium price or market clearing price. There will be a single price in the market such that quantity demanded will be exactly equal to quantity supplied. Please pay attention now. There will be an exam question based on this material. Exam question. Each of the students, everyone, will be asked to calculate equilibrium price and quantity based on certain formulas for demand and supply curves. You will be given equations describing demand and supply relationships in mathematical form, and you will be asked to calculate price and quantity. Each of the students will get this question, and this question will be worth 2 or 3 marks. There will be a seminar question describing how to do this, and please pay attention to this. Please make sure that you practice and you are able to solve this yourself. I will also record a separate video describing how to do it, going through a particular example. So please make sure that you watch this separate video. There will be an exam question. Let's see how exactly the market mechanism works, how exactly equilibrium price is established in a market. Let's imagine that we still talk about the market for potatoes. We have certain possible prices, for example, varying from 20p to £1 per kilo. And there will be certain market demand given by numbers in this column for potatoes and total market supply. Apparently, we can observe here the law of demand in action. As price increases, quantity demanded will drop. Consumers are prepared to buy less potatoes when price increases. And the other way around for supply. As price goes up from 20p to £1, quantity supplied will increase from 100 to 700 tons. We can also see that there will be a single price, 60p. This is a price where quantity demanded will be exactly equal to quantity supplied. At this particular price, the market will clear. Equilibrium will be established. Graphically, we can find this price at the point where demand crosses supply. So if we draw using the numbers in the table, if we draw demand curve, if we draw supply curve, they will be represented by these blue lines, and equilibrium will take place where quantity demanded is just equal to quantity supplied at price is 60p. What will happen if price is established at a different level? So let's imagine that original price is 40p. How do we know that it will need to move towards 60p? Let's imagine that initial price is 40. At this price, there will be a gap between quantity demanded and quantity supplied. Quantity demanded will be determined by this point capital B, shown by capital B, on the demand curve. In other words, it will be equal to 500 tons, while quantity supplied will be shown by this point, little b. In other words, it will be 200 tons, which implies that at this current price, 40p per kilo, there will be a shortage of 300 tons in the market. This price is very low, which means that suppliers are not willing to supply as many items as consumers are willing to purchase. It's cheap for consumers to buy, so that's why they want to buy a lot of this product, while for producers there is not much incentive to produce that many items because price is low, profit margin is low, so they prefer to switch production to some other more profitable activities. And as a result, there will be a shortage of products on the market, more consumers than product available, and it will be equal to this difference between quantity demanded and quantity supplied. In other words, when we experience this shortage, the market can clear if price goes up. When price is initially set at this situation, when we experience a shortage of products, there will be some consumers who will be prepared to pay higher prices in order to get their products. There were 500 customers, but only 200 of them managed to purchase potatoes, and the rest had to leave the store with nothing. Some of these customers will be prepared to pay higher prices in order to get their potatoes. And in other words, price will start increasing. And as price goes up from 40p up, number of suppliers who are willing to sell potatoes will increase as well. And eventually, quantity demanded will meet quantity supplied when price is equal to 60p. The opposite situation will happen if initially we'll start with a price which is higher than equilibrium. For example, let's say that initially the price is equal to 80p in the market. Let's imagine that you are a farmer who produces potatoes and you bring certain amount of potatoes to the open market every day. You sell your potatoes in an open market. And initially you try to charge your customers 80p per kilo. And this higher price, you will be quite happy to sell a lot of these products. You will be willing to supply approximately 530 kilos or tons of potato to the market, while demand will be relatively low. Quantity demanded will be determined by this point on the demand curve, capital D, which will be only 200 units. In other words, there is 530 tons of potatoes available in the market, but only 200,000 customers who are willing to purchase them. In other words, there will be a surplus or excess supply of products in the market equal to this difference between quantity demanded and quantity supplied. What will you need to do if you're a supplier in this situation? You only manage to sell 200 tons out of 530 which you've had available. So in order to get rid of this additional unclaimed potatoes, you will need to discount them. You will need to reduce your price. And as the price goes down, quantity demanded will start to increase. But on another hand, as price drops, there will be lower incentive for you to provide this many potatoes next time. So next time when you come to the market, you will grow less potatoes. And as a result, quantity supplied will drop, and it will keep adjusting. Both quantity demanded and quantity supplied will keep adjusting until they meet at a certain point, until the price reaches equilibrium, where there is no more incentive for the price to adjust up or down. In other words, the market equilibrium will be established due to price adjustment mechanism. If price is initially set at too low level, it will need to increase. There will be a deficit of products in the market. If price is initially set at too high level, there will be excess supply in the market, the gap between quantity supplied and quantity demanded, which means that price will need to drop. There will be the only price in the market which ensures that quantity demanded is just equal to quantity supplied. In your exam, each of the students will get a question asking you to calculate deficit or shortage on the market based on certain formulas for demand and supply curves. Numbers which you will get might be different, but each of the students will get this question. And usually it's worth about 2 or 3 marks. It's one of the harder questions in the exam. So I'm writing down here that you will get an exam question where you will be asked to calculate the size of deficit or surplus. Pay attention to this, please. You will be given formulas and you will need to identify what happens in the market at a certain price. Are you experiencing surplus or deficit in the market? You will need to identify what exactly is happening and the size of this deficit or surplus. In your seminar, there will be a question which will show you how to do this. Please make sure that you pay attention to this particular exercise because it will come up in the exam. I will also record a video where I will explain how to find equilibrium price and quantity, because this will be another question which each of the students will get in the exam. So 60 is our equilibrium price. This is the price where quantity demand is just equal to quantity supplied and equal to 350 units or tons. So summary, excess demand is a situation when quantity demanded exceeds quantity supplied at a certain price. Quantity demanded is greater than quantity supplied. In other words, excess demand is a situation when we experience a shortage or deficit of products in the market. Consumers are willing to purchase more items than what's available in the market. As a result, price will need to increase. And the other way around, excess supply is a situation when quantity demanded is lower than quantity supplied. There will be less consumers in the market compared to quantities available. There will be surplus of unsold products in the market. And when there are too many products on the market which no one wants to buy, price will need to fall. Price has to be discounted. Next part of our lecture is changes in market equilibrium following certain shifts in demand and supply curve. Let's imagine that our initial situation looks like this. We have a certain demand curve shown by this blue line, certain supply curve shown in red, and we have initial equilibrium, this dot where both curves cross. The initial equilibrium price is P1 and the initial quantity is Q1. This is our initial equilibrium. Then we experience a shift in demand curve. As a result of a shift in any of the curves, we will have a new equilibrium, which means that the market will clear at new price and new equilibrium quantity. So, for example, when demand goes up, maybe because consumer income has increased, or we managed to run a very successful advertising campaign which increased demand for our products, this will shift demand curve upwards, and the new demand curve will be shown by this dotted line labeled D prime. As a result, our new equilibrium will now be established at this point higher along the same supply curve. In other words, new equilibrium price will be equal to P3 and new equilibrium quantity will be equal to Q3. How exactly will this adjustment to new equilibrium take place? We will follow the same logic which we've covered already. Let's imagine that our initial equilibrium is at this point G. Next, our demand curve shifts upwards or to the right. Our new demand curve will be shown by this red line D2, which means that at the original price, which we used to have before, we will experience a gap between quantity supplied, shown by this point, QE1, and quantity demanded, shown by point H on the demand curve. At the original price, there will be excess demand compared to supply available. There will be more customers willing to purchase certain products compared to supply available, compared to how many units are available. Because consumers are queuing to buy our products and there is not enough product available, producers will be quite happy to increase the price. And some consumers who couldn't purchase the product they wanted, they will be able to pay more. As a result, price will adjust upwards. Whenever we experience a deficit or shortage of products in the market, there will be upward pressure on price. And as a result, price will increase until it will reach new equilibrium point I. So our price, new equilibrium price, will be established at a higher level, shown by this red number PE2. And at this higher price, there will be higher quantity sold, QE2. So in other words, this particular market, due to shift in the demand curve from D1 to D2, will move an equilibrium point from point G, original equilibrium, to a new equilibrium on point I. This is our new equilibrium. Price is now higher, quantity in the market is now higher as well. What will happen if we experience a shift in supply curve instead? Similar logic. Initially, we are located at original equilibrium point G. Then we experience a shift in supply curve, maybe because cost of production is higher, or maybe because suppliers are shifting towards producing another more profitable product, or maybe because suppliers have negative expectations about future profitability. Regardless of the reason, supply curve shifts to the left, and new supply curve is shown by this new green line S2. At the original price, PE1, there will be a gap between quantity demanded and quantity supplied. In other words, quantity demanded will be shown by this point G, while quantity supplied will only be determined by another point on the supply curve. There will be insufficient quantity of items available compared to demand for them. There will be more consumers compared to products available. In other words, again, there will be a deficit in the market. Quantity demanded is higher than quantity supplied at the original price, which will put upwards pressure on price. And as a result, the market will adjust until it will reach new equilibrium point K. In other words, new price will be established at a new green level PE3, and new quantity will be given by this number QE3. In other words, due to a shift in the supply curve upwards or to the left, there will be higher price in the market and lower quantity sold. And we apply the same logic whatever happens in the market. We simply try to figure out what happened, what curve will be affected, demand or supply, whether it will be a movement along demand curve or a shift in the curve, and how it will shift to the left or to the right. And after this, we simply plot this on a diagram and see what will happen to our equilibrium point, where the new equilibrium point will be located. Then we will be able to figure out what happened to prices and what happened to quantities. So we use this model to analyze a variety of changes in the market. We can analyze changes in exchange rates, for example, or changes in prices of gold, or changes in any products, or changes in the wage rate. The logic is absolutely the same. We use the same demand and supply diagram, and it can be applied to thousands of various situations. Extremely useful and easy to use model. For example, if we have a shift in both demand and supply, we simply shift both curves and see what will happen to equilibrium prices and quantities. Let's imagine that we experience rightwards shifts in both supply and demand. So our original situation was shown by these thick lines, original demand curve shown in thick line D, and the original supply curve shown by thick red line S, and then both original equilibrium, initial price P1, initial quantity Q1, and then both curves shift to the right. So our new equilibrium will be established at this point, which, based on how we've drawn our curves, implies that we will have a small increase in price from P1 to P2 and a significantly larger increase in quantity from Q1 to Q2. The results can, of course, depend on the relative size of the shift in both demand and supply curve, which curve will shift by larger amount. Example. This is an example of a question which you might get in your test based on this information which we've just covered. For example, initial equilibrium is established at point X, and there is a variety of possible answers. What will be a new equilibrium if there is a rise in the cost of producing a certain product? We are discussing a particular product. There is a rise in the cost of production of this product. Where will we have a new equilibrium? Stop the video, answer the question, continue when you are ready. Ready? Okay, cost of production. Which curve will be affected, demand or supply? Supply, it's a manufacturing process which will now be more expensive. How will supply be affected? Will it shift up or down? It will shift upwards because every point on the supply curve will now need to move higher towards higher prices. Each original quantity, regardless of how high this quantity is, will now be sold at higher price. So the original supply curve S0 will move towards a new supply curve S2. As a result, our new equilibrium will move from point X along the original demand curve, because demand curve wasn't affected, towards a new equilibrium where our demand curve crosses new supply. In other words, the location will be point 8. The correct answer is point 8. This is the point where original demand crosses supply. Let me just draw you a diagram to make it slightly clearer for you to understand. So this is price, this is quantity, this is our original demand and supply, D0 and S0. Then we experience a shift in the supply curve upwards. So our new supply curve is now S2, which means that we move from point X to point 8. 8 is our new equilibrium. So the answer is 8. This is how you should tackle this question. Reading for this particular topic is given on the screen. All of this is compulsory, so please make sure that you cover this material. But most importantly, practice doing seminar questions. That's it for now. Please make sure that you do all seminar exercises. This is very important for your exam.